Well, welcome to Fidelity Soundbites, a straight-to-the-point monthly podcast where you will learn from some of Australia's leading portfolio managers on what's happening in markets, how they're positioning their portfolios, and the outlook going forward. I'm your host, Andrew Dowling, and in this episode we have Paul Taylor back to reflect on markets and the outlook. Paul, welcome, and great to have you back again.
Andrew, thank you. Good to be back.
Now, Paul, given the last 18 months, arguably, equities probably shouldn't have performed as well as they have. You've got risks continuing to enter the market in different shapes and forms, and it's really hard to find anyone with something positive to say, yet markets, in one shape or form, continue to go up. Talk us through that. Why is that happening?
Yeah, Andrew, very interesting. Actually, in market parlance, you'd say that's the market is climbing the wall of worry. Now, that's actually quite a positive sign, which seems unusual, but it is when you keep having new risks enter and a range of issues and the market keeps going up. It's actually just telling you there's a lot of money sitting on the sideline that's entering on the back of bad news, which is a pretty positive sign. When I think about it, there really has been a lot of risk into the market, whether it's interest rate risk or inflation risk or geopolitical risk, recession risk, regulation, taxation. There's definitely a lot more to worry about. And in that environment, and just even with just a higher risk-free rate, it's just a better time to be thinking about an investment. When it's all there in the market, typically that reflects a better longer-term expected return, if I can put it that way. But look, I think it's the market. We're climbing the wall of worry. That looks a lot better. You've even got things like another sort of positive signal is we're seeing a lot more M&A, mergers and acquisitions, in the market at the moment, and that's also corporates tend to be much longer term. Their views are much longer term. They're not looking at buying a business this year and selling a business next year. They're buying one now to hopefully hang on forever. So they're just really looking at, well, what's a good long-term entry point? So, I think that M&A has really stepped up, and I think that's probably also reflects corporates seeing better long-term investment opportunities in the market right now.
Now, so with risk comes opportunity, and to your point on the M&A, what's impacting you on that front? Companies that you own?
Yeah, Andrew, it's actually interesting. So right at the moment, there's 3 stocks in the portfolio that are currently under takeover bid. Now that is a bit unusual for me. So you look at when we've had one that's been there for a while. So Brookfield is leading consortium that's bidding for Origin Energy, and that's getting closer and closer to completion. As we sit here today. That's one. We've got Wesfarmers that's bidding for Silk Laser, and that's also interesting. Silk Laser is a smaller cap stock. It's been quite volatile, but Wesfarmers made quite a large premium in a takeover bid, just saying, well, this is reflecting good long-term value for Silk Laser. And then we've also had Kirin, a Japanese beer and I guess consumer goods food business that's come and made a bid for Blackmores. So it's, that is have 3 is quite unusual, but like I said before, it sort of reflects probably they're representing great long-term value.
Yeah. And just for the Silk Laser business, what's talk us through that company, what its value proposition is?
Yeah, well, Andrew, you probably will know Silk Laser much better than me because it's sort of beauty care. So it's hair removal. It's also injectables, that sort of business. And that business has been growing very rapidly. But it has been a very strong growth. Wesfarmers bought API, which is a chemist, but they had on the side of that chemist was another sort of business like Silk Laser. And they were just trying to work out how to, there was a bit of an issue for them. It wasn't really in a good spot. So Wesfarmers either, I think, had to sell that business or get bigger or try and solve their problem. So they've obviously gone the second route, which is looking at Silk Laser. Silk Laser is actually a well-run business, good, well-positioned, good management team. So Wesfarmers are probably looking at it to get the management team that actually can help them turn around their own business.
Yeah, a different form of renovating to the Bunnings business that they also own, I gather.
Definitely. But actually you can see now Wesfarmers is on a bit of an acquisition route as well. So Wesfarmers have now completely sold out of Coles. They went through that process, sold out of Coles. So they've got a lot of cash, and you can see that Wesfarmers have been bidding for resource companies, and now also in that sort of beauty care space as well. But they're just looking for good high returning business, good long-term growth businesses, high returning businesses. And I think we'll see more of that sort of corporate M&A going forward as well.
And Paul, Blackmores, the well-known Australian vitamin business, being acquired by a Japanese company, Kirin. Can you talk us through that acquisition?
It's actually interesting. Kirin has been, it's actually been active in the Australian market for quite a while. In fact, they bought, actually fairly early on, with the Australia Fund, they bought Lion Nathan, which was a beer company here in Australia. And we actually owned Lion Nathan at the time. So they that was an earlier takeover. So Kirin has been good to us a couple of different times. But they obviously like Australian businesses. I mean, Australian businesses, they're high quality, good management teams, good cash flow, just well-run businesses. And I think they're looking at Blackmores in the same way. So Blackmores, as you said, it's a vitamin company. Vitamins have been a structural growth area, and it's been a growing area. So Kirin, I'm sure, similar to Lion Nathan, really likes the good structural growth, the strong cash flow coming out of Blackmores, and is looking at Blackmores as a long-term investment.
Yeah, and I suppose for a beer company, the acquisition of Blackmores gives them an additional source of vitamin B in one shape or form, doesn't it?
Yes, well done.
And Paul, the RBA put up rates by 25 basis points from 3.6 to 3.85%. Does that change your view on recessionary risk or opportunities across the market?
Look, I think growth in Australia will really come down in 2023. It will be a weaker growth year. We would still be of the view that it's not going to take us into recession in Australia, but that's certainly not guaranteed. And I think the RBA, in taking up rates another 25 basis points, is really just following the data. So inflation has come down, and we're on it's good. It's a good trajectory, but it's still too high, and they're really just trying to work for the long term and get inflation down. So they'll keep going as per the data. Now, so there still is a risk that rates could go up more. That now that a recession becomes more of a viable option. But I mean, our view at the moment is that probably the US and Europe go into a recession, but Australia still stays out of recession. I think it's actually we've got counterpoints. Our population is growing quite strongly. We've reopened to immigration. That's a really positive impact on markets and the economy. And I think our ties to Asia will help us sort of avoid recession as well. So at the moment, even though rates have just gone up another 25 basis points, our view would be no recession in Australia, but we got to see how things go. And while inflation is coming down, we still think there's probably a couple of reasons they might remain a little bit higher, a bit more structural. They'll be a little bit higher for structural reasons. And those two structural reasons, one is decarbonisation. So as we go through the decarbonisation process, that does add costs to the system.
And that's a multi-decade.
That's a long time. So that's going to stay high, a little bit higher for a little bit longer. And the other thing is just sort of logistics and supply chain and I guess deglobalisation. So, there's a policy now, a lot of companies go by this one called China Plus One, which is previously you had your factory in China. Now through COVID and through deglobalisation disruptions, basically people said, well, actually we need another factory somewhere else. So we'll have China plus one other. Maybe we'll have that factory in Australia or we'll have that factory in Vietnam or, wherever they decide, basically to help with logistics. But the issue is that is also, that adds costs into the system. That builds redundancy, which is good from a guaranteeing supply, but it does increase your costs and the deglobalization does also have an element of inflation built in as well. So you've got a couple of structural drivers now, where inflation has come down from like 8 to closer to 7, which is better, but that's still too high. So the target is 2%. Now, maybe we don't get back to 2, but if we get to 3 or 4, I think the really interesting question will be, well, is that low enough for the RBA or other central banks around the world to stop raising interest rates? And I think, that little bit of flexibility, that might be okay. If we can get back closer to 3, 4, Maybe that's low enough, which is still maybe a little bit of structural increase in inflation, but much more manageable levels.
Mm. And so, taking into account the current environment and the never-ending noise in markets, what stocks, what areas, what sectors do you like at the moment? What do you expect to continue doing well?
So what really works in this sort of environment, one is consumer staples. Now those sort of, everybody needs their food, everybody needs their, the drink or the essentials, the toiletries or whatever it is. That even if there's a bit of inflation there, you have to have that. Same for health. There's nothing you can do about it. If you've got to go to the hospital, you've got to go to the hospital. So people will pay that inflation.
And as you pointed out earlier, Silk Laser is probably an essential for me. So I gather I'll be keeping that up.
Well, it's an interesting one. And actually that's, one of the reasons it was quite volatile was people weren't sure whether it was, how discretionary it was. And I think through time, it has actually proved, exactly to your point, it's proved maybe a little bit more essential than discretionary. And I think that'll be interesting as well. Like, you also can ask that question about telecommunication, like your mobile phone. It's no longer discretionary. That is essential. So maybe what is essential and what's discretionary has changed a little bit through time. But I think what really is discretionary is, a new fridge or a new lounge or a new car. You can delay, even if you still need to do it, you can delay it a year. So rather than buying a fridge this year, you buy it next year. The other thing that really works well is self-help stories. So, like if you just go up and down based on market conditions, you're in for you're in a weaker growth year. You're in for a tough year. But if there's something you can do about it, there's something you can restructure in your own business and just improve your position, you're obviously going to do much better.
Yeah, and property
tends not to do as well because you got higher interest rates. So
how do you navigate that in terms of what you own and what companies?
Yeah, so within the property sector, I tend to look at we look for structural growth. So as a great example, one of the positions we own is Goodman Group. Now, Goodman Group's an industrial property company. Now, that has strong long-term structural trends. So what's been happening, e-commerce has been a big driver. And basically, for a lot of businesses, that e-commerce is becoming a bigger and bigger part of it. Now, you don't necessarily always need a shop front. You can basically work out of a shed, and that's what industrial property provides you. So you're working out of a shed; it's much cheaper, and you're just sending it out, via e-commerce.
And for established properties, the replacement cost is just going up and up, and that's not going to change by the looks of things. That I suppose provides some sort of premium for existing.
Look, there's a few offsetting factors, but I think the really interesting one. So what we hear from a lot of retailers, to give an example, right? So a lot of the rents that are in retail contracts each year it goes up by CPI. So CPI is at 7%. So these discretionary retailers I'm talking about is going to have a very tough time because of higher interest rates. Their rent is going up 7 to 10% a year. Now, that's a huge squeeze, and something's got to give. And the thing that's also there is when you value a property company, it's valued basically on a capitalization rate. So typically, as interest rates go down, what's called the cap rate, a capitalization rate, might have got down to 4%. Now, as interest rates go back up, it's probably going to go back up to 6-7%. The higher the interest, like a bond, the higher the interest rate, the lower the value. So we'll see capitalization rates go up. They tend to be very slow to go up, but they do go up. And you'll also see much greater pressure on rents. And the office space is going to be in a similar position, right? So people are, they need less and less space, a bit more work from home. Now, people are coming back into the office, but they're still not coming back 100% into the office. So they need, you need less off. But once again, that takes time to unravel. So office the same, but industrial is probably better protected in that it's cheaper. People can typically work out of a shed. Like I said, they can move to e-commerce. If they don't want to have the shop front, they can move to e-commerce, which is actually proving itself much more successfully for a range of different businesses as well. And yeah, it's a better business model. The other thing we really like with industrial properties, Goodman's a global leader. So we're always looking for like the best in class quality businesses that are going to deliver in the best property sector.
Excellent. Well, we'll leave it from there today. Thanks, Paul. Always appreciate your time and insights and observations on where we're at and where we're heading. We'd also love to hear from you. If you'd like to send through any of your questions to Paul to answer, send it through to podcastaustralia@fil.com. And thank you and bye for now.
Andrew, thank you. Good to talk to you.
Some important information on today's podcast. This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australian products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.